Hi, everyone, and welcome.
Hey
It's good
guys.
to see everybody again. Please let us know. Welcome back to our weekly broadcast and podcast. Please let us know where you're tuning in from. And if you were with us last week, you talked with us about rental property depreciation and depreciation capture. Brian gave us a lot of information. We got a lot of good comments and questions as well. This week, we're going to be talking about taxes, dun, dun, dun. End of year money moves for real estate investors. We all dread the end of the year to April 15th, and
Hmm.
you get an extension in the whole 9 yards. But they're here. We're going to provide you with some good, useful information on how to maximize some of your deductions. And please, we have to add this disclaimer. We are not financial consultants, nor are we accountants. So please make sure that if you're going to use any of these strategies, or if you have any questions about them, that you direct them to your accountants.
That's
And with
right.
that being said, Brian, start us off. What about those capital improvements?
Sure. So capital improvements extend the usable life of your building, and they are depreciable. That means you can deduct the cost of them over many years instead of taking all of that deduction in a single year. But if you get started on them now, or if anything you pay now towards capital improvements, you can start depreciating for this year. So if there is an improvement to your property that you've been thinking about, consider
Now,
doing it now.
talk to us a bit about, because I know this is a confusion for a lot of people. What is a capital improvement compared to, just any
Or
old
basic
upgrade?
repairs.
Mm-hmm.
Yeah, so capital improvements, they extend the lifespan of your building or raise the property value. So an example of a capital improvement is a new roof on the property, new furnace, for example, anything that extends the usable life of the building, as opposed to maintenance or repairs, which are repairs are just isolated expenses to fix something that's broken, and maintenance is ongoing upkeep costs, such as painting, mowing the lawn, these
Right.
sorts of ongoing expenses.
What about like additions and that kind of thing?
Those would be capital improvements.
Gotcha.
And capital improvements are depreciated just like the cost of the building itself over 27 and a half years.
Good old half there. I love that they make it more confusing.
Oh yeah, of course. It's the IRS. So
Now we have sorry.
Oh, so Sandeep, he says, do we have to 1099 contractors to claim tax deductions or depreciation on repairs and improvements? So if you pay them more than $600 for the entire year, for the calendar year, then yes, you should be sending them 1099s by law. Deni, do you have anything to add on that particular point?
Before they even start, I would get their I always get them
W9.
W9. It's like 429. Yeah. Because often you'll have them start and then you'll ask and they'll put you off, and then you're in a really precarious situation. So you want to make sure and get that information.
Yeah, they don't like to give this stuff to you. For one thing, it has their personal details like their social security number, which people get a little twitchy about giving out, and don't want to receive 1099s. They would just as soon sweep that under the rug and pretend that they didn't get that income when the IRS comes calling. By the way, I did add a link here in the comments to our free rental property depreciation calculator. So you can run the numbers on how much you can depreciate each year for capital improvements or for property in general. Now, we touched on maintenance a minute ago. By the way, maintenance costs and repair costs, those are deductible this year, the entire cost deductible for this year. So those are another thing that you can wrap up before the end of the year if you want to deduct them on your taxes for next year.
Absolutely. And it's important, keep all your receipts, all of that stuff. I mean, most people know that anyway, but sometimes if it costs not much, you tend to not worry about it, but it adds up.
Yeah, and if you're ever audited, you're going to need to produce that documentation, or else the IRS may decide not to let you take that deduction, and they'll not only tax you on it, but they can hit you with penalties.
Penalties, yes. Good old audits. So Brian, talk to us a little bit about harvesting losses. How can we offset some of those?
Yeah, so when you sell an asset for a gain, the IRS taxes you at the capital gains tax rate for that profit that you made on it. You can offset those taxable gains by with losses. So if you sell an asset and take a loss on it, then those losses can offset your capital gains that you're taxed on. Now, you don't want to intentionally go out and lose money, right? But if you do have some investments in your portfolio that you've been meaning to sell anyway, they've been underperforming for you, that you consider like losers in your portfolio, uh, in a year when you do have some gains that are going to be taxed, you can harvest those losses by, just taking the loss, as they say, cutting your losses on it, and then reinvesting the money somewhere else that's going to
Right.
perform better for you. There's no reason to hold on year after year after year to these loser investments that are just not performing for you. So, for example, if you have some stocks that just have not gone the way that you thought they were going to go, and they keep underperforming the rest of the market, then just cut your losses, sell them, and you can take those losses that you incurred and use them to offset your capital gains from real estate. And we've got a link here if you want more information about either harvesting losses or about other ways to offset capital gains taxes. We'll put a link to that in the comments as well here. Now, one other thing that you can do to have some deductions here by the end of the year is to buy a property before the end of the year. So if you're in the process of buying a property, obviously we're getting close to the end of the year here, but
Yeah,
if
you're
you're in the
cutting it really
process,
close.
yeah, right. But real estate investors, a lot of them move fast, right? And that's how they
Right.
get such good deals. Yeah, if you can settle before the end of the year, then some of those closing costs that you incur are deductible for this year. The remainder of those closing costs are depreciable over the 27 and a half years, along with the cost of the building itself can also be depreciated, including you can prorate the depreciation for that building for this year as well. So you do get some deductions there if you buy a property before the end of this year. Something to consider.
Right.
And if you are selling a property this year, or if you have sold a property this year, you can do a 1031 exchange on it. Now, 1031 exchanges get a little tricky and a little complicated. You do have to declare your replacement property that you're going to buy to replace the old property you sold. You have to declare that within 45 days of selling the old property. And then you also have to settle
Now,
on
what
the
do you
new
mean by
property.
declare?
So when you do a 1031 exchange, so we're bouncing around a little bit here. You have to use a qualified intermediary to hold your profits and to oversee the transaction for you, or really both transactions, because a 1031 exchange is a swap. So you're selling one property, and you're buying another. So there's two transactions here. The intermediary oversees those two transactions, and they actually hold your profits for you so that you never actually touch those profits. So you have to declare to the intermediary and to the IRS what property you're going to buy to replace the old property that you sold. You have to declare that within 45 days of selling. Now, the IRS does recognize that sometimes things happen in
Right.
real estate investing, and sometimes deals fall through the cracks. So they let you specify up to 3 different replacement properties. You only have to settle on one of them, of course. But you can specify up to 3 properties that are your possible properties that you're going to replace the old one with. And then there's a second timeline here. Within 180 days of selling the old property, you have to settle on the new one in order to qualify. And if you're not familiar with 1031 exchanges, and this all is Greek to you, it lets you defer capital gains taxes on your investment properties. So quick example, you buy a small single family rental that only cash flows like 100, 200 bucks a month, whatever. You own it for a few years, you make some cash flow, you get some equity in it, and you turn around and you sell it, and you want to take your proceeds from that property and roll them into a larger property, maybe like a triplex or a quadplex. And you don't have to pay taxes on your profits from the sold property if you roll those profits into a new property, a new investment property. So you can keep doing that to keep swapping out your properties and upgrading them over the entire course of your career if you want, and never pay capital gains taxes until the day that you sell a property and don't roll the profits into a new investment property. So
now there are, I'm sure there are financial professionals or accountants that can help you set all of this up, because it sounds like a lot of juggling and time, limitations. So
yes, you do want to speak with either a tax attorney or an accountant about 1031 exchanges before doing one, and you will need to bring in a qualified intermediary, which does not have to be a professional. They don't have to be licensed or anything, but they can't be you, and they can't be your immediate family member, and they can't be someone who's already serving as your agent, such as a realtor or an attorney, property manager, someone who's already working for you in some sort of agent capacity. Can't
so
be that.
somebody completely neutral.
Yeah, and we do have an article that actually we just published all about 1031 exchanges. I put a link to that in the comments as well if you want to learn more about 1031 exchanges and how they work. All right, moving on. You can also make charitable deductions, right? Either cash, or you can actually donate an entire property to charity if you're really feeling generous. But keep this in mind though. If you make a charitable donation, whether it's cash or a property or a car or whatever it is, it's only deductible if you itemize your deductions. If you take the standard deduction, then it's not really going to help you unless, and here's where it helps to be a real estate investor and to have a business. You can make these charitable contributions through your business and still take the standard deduction, because if you make these contributions or donations through your business, then that comes off your business's bottom line, right? And it becomes deductible as an expense, as opposed to your personal make personal donations. Then you have to itemize your deductions if you want to actually take advantage of that.
Right.
So something to consider.
People.
Well, absolutely. And of course, charitable donations are also taxed. You don't pay any taxes on profits on any of that if you donate a property. So keep that in mind. You can also prepay your bills. So, for example, if you have mortgage payments for January coming up, which if you have a mortgage and you do, you can make your January payment early and deduct the interest on that. Of course, that means one less interest payment next year that you can deduct. So, but if you made extra money this year and you think your taxes are going to be higher this year than usual, higher than next year, then you may want to take some of these deductions early. Take them this year instead of next year. So you can also you can use tax credits, like, for example, the American Opportunity Tax Credit. You can take for students if you're helping them with their tuition. You can take that. And again, tax credit is better than a deduction. The tax credit comes right off of your tax bill. You can take the American Opportunity Tax Credit, for example, for $2,500 a year for each qualifying student. So,
which is helpful.
Yeah, so you can prepay some of these bills like mortgages or prepaid tuition, and potentially take advantage of either the deductions or even a tax credit. You should also review your medical bills at the end of this year in case you want to deduct for your medical expenses. In order to deduct for medical expenses, they do have to be at least 10% of your adjusted gross income for you to deduct them. So keep that in mind. And I think you have to itemize your deductions in order to take advantage of that, right, Deni?
Yes. Mm-hmm.
Yeah.
Absolutely.
So, but yeah, as you look back over this year, look at those. And if there's a medical procedure that you've been thinking about getting and maybe putting off, that might, if that will put you over that line, that threshold of 10% of your adjusted gross income, maybe it's worth squeezing it in this year so you can deduct those expenses. I mean, I'm just throwing ideas out there.
No, it makes sense. I mean, in a lot of ways, like if you have deductibles and stuff and you're entering into a new year and you want to get some stuff done, it's a double whammy. You can meet your deductible before the next year and having to start over and get a tax benefit.
That's right. And potentially have better health if you need
And
these medical
too.
procedures.
Oh, there is that.
Yeah. So, lastly, now's a great time to contribute to your tax sheltered accounts. That could be retirement accounts like your IRA or your employer sponsored retirement account like a 401k. Could be education accounts like a 529 plan or an ESA. could be an HSA, a health savings account, which, by the way, offers the best tax benefits of any tax sheltered account. Not only can you deduct your contributions, but you don't pay any taxes on the withdrawals either.
Only if
So
they're used for medical, right?
that's right. But they actually allow a very generous definition of medical expenses, shall we
Okay.
say.
Wow.
And when in retire, you can also use an HSA as a duplicate or another retirement account, because I guarantee you, in retirement, you're going to have medical expenses,
Mhm.
high medical expenses, and that money has to come from somewhere, right? So it could either come out of your own pocket or it could come out of your HSA. So
Yes.
HSAs double as a retirement vehicle as well. Um,
Very
Denny,
cool.
what did we miss? Did I miss anything here? Is there anything you want to add?
No, you did really good there. I learned too. I love these things because I learned too.
Well, keep in mind,
No,
guys, I am not a tax expert. So, before, these are really just ideas to get you thinking. You should really speak with, like Denny said, an accountant or a tax attorney before you take one of these and run with it. So,
and
just
let
something to
us
think about.
know if you have any ideas that we can offer to, people who read the blog and whatnot that help them. That's what it's all about, helping each other. And there are a lot of little tips and tricks.
Yeah, so a lot of these are tax tips, and we'll certainly be talking a lot more about taxes over the next month or so, as it's that time of year. But yeah, some of them are also just general financial cleanup. So, all right, well, Denny, if there's something else you want to add, then we'll see you guys next week at 2 o'clock Eastern, 11 a.m. Pacific, and let us know what you want to hear about. Again, these are we do these for you, not to sit here and talk to each other.
Yeah.
So let us know what topics you want to hear. Message us at Spark Rental on our Facebook page, or support at sparkrental.com to email us. And we'll see you next week at Tuesday, 2 o'clock Eastern, 11 a.m. Pacific. Have a good one.
Yes.